Welcome to this comprehensive financial analysis of Civitas Resources, ticker CIVI. Our goal today is to assess its competitive positioning within the U.S. oil and gas sector and determine if now presents an opportune moment for investment. This analysis reflects my personal views and insights as of October 12, 2025. Civitas Resources is an independent U.S. oil and gas producer, primarily operating in the prolific DJ Basin in Colorado and the Permian Basin across Texas and New Mexico. With a market capitalization of approximately $3 billion USD, the company's production mix is heavily weighted towards oil, at about 70%, with the remainder being gas and NGLs. Their strategy emphasizes disciplined capital spending, a strong dividend policy, selective share buybacks, and a focus on sustainable free cash flow generation and debt reduction. When we compare Civitas to its peers, we observe several key valuation metrics. The current share price, along with PE and forward PE, looks attractive. Crucially, the price relative to fair value, based on discounted cash flow models, suggests potential undervaluation. As you can see, this is the case for all the companies, not just Civitas Resources. It's important to note and remember that these valuations are highly correlated with oil prices, which are currently around $60 per barrel. Civitas stands out with its robust shareholder return program. The company offers an impressive combined yield of approximately 18%, comprising a substantial 11.2% from share buybacks and a solid 6.8% dividend yield. This total yield is highly competitive within its peer group, demonstrating a strong commitment to returning capital to investors. Such a high yield can be a significant draw for income-focused investors. Examining Civitas's financial strength, we look at key indicators like debt to equity, free cash flow coverage of interest, and free cash flow coverage of total debt. Civitas has higher debt than peers and relatively low free cash flow to interest payment. This could introduce financial pressure in case of increased interest rates or falling oil prices. Civitas boasts highly competitive breakeven points, estimated at around $40 to $45 per barrel across its DJ and Permian assets. This positions the company favorably, as most producers remain profitable above $50 per barrel. Civitas, alongside MTDR, is particularly well positioned to withstand lower oil price environments due to its low-cost, full-cycle portfolio, offering a margin of safety for investors. The global oil demand outlook suggests slow continued growth, with 2024 demand around 103 million barrels per day, expected to plateau near 105 million by 2030. While OECD demand may decline, growth in India and Southeast Asia is expected to continue. Global proven reserves of 1.75 trillion barrels indicate approximately 50 years of supply at current consumption rates, with OPEC controlling 70%, but North America holding substantial shale reserves. The long-term oil price outlook forecasts Brent crude between $55 and $75 per barrel through 2030, with WTI typically a few dollars lower. Upside factors include underinvestment and geopolitical tensions, while demand slowdowns and shale expansion pose downside risks. The market remains balanced but volatile, influenced by the energy transition in road transport to EVs, which reduces long-term intensity, though petrochemicals remain a key demand driver. Understanding oil consumption by sector reveals that transportation, encompassing road, aviation, and shipping, accounts for the vast majority, approximately 60 to 65% of global oil consumption. Petrochemicals, industry, and residential use make up the remaining significant portions. This distribution highlights the critical role of transportation in driving oil demand, making it a key area to monitor for future consumption trends. Investing in Civitas, like any energy company, involves specific risks. Oil price volatility directly impacts earnings, and regulatory changes in Colorado, particularly concerning ESG and permitting, could affect operations. While the company manages its debt, a higher leverage compared to some peers could expose it to larger downside risks. The cyclical nature of commodity markets also influences valuation significantly. The investment case for Civitas is compelling. The company appears approximately 55% undervalued compared to fair value and its peers. It offers an attractive 18% total yield through dividends and buybacks, coupled with an 18% free cash flow margin, indicating consistent profitability. Its low-cost assets in the DJ and Permian basins ensure strong resilience. There's significant re-rating potential if oil prices grow. While Civitas presents a strong investment case, it's crucial to acknowledge the key risks. Commodity price volatility remains a primary concern, as earnings are directly tied to crude oil prices. Regulatory exposure in Colorado, particularly regarding environmental and operational permits, could impact future growth. Additionally, the company's leverage, while managed, is higher than some peers, potentially increasing its sensitivity to market downturns. In conclusion, Civitas Resources offers a compelling investment proposition. It combines high income generation with low-cost operations and a deep valuation discount. For investors seeking strong cash returns and who believe oil prices will remain stable or grow, Civitas represents an attractive opportunity. Its operational efficiency and commitment to shareholder returns position it well in the current energy landscape. Please remember, this presentation is for educational and informational purposes only. It reflects my personal opinions and trading approaches and should not be considered investment advice. I do not hold a position in Civitas Resources, nor am I compensated by them or any third party for this content. Investing in stocks carries inherent risks, including the potential loss of capital. Past performance is not indicative of future results. Always conduct your own thorough research and consult a licensed financial advisor before making any investment decisions.